Hello, it's Jeff Christian from CPM Group. This video is being released on Tuesday, the 24th of August. We actually filmed it on Friday, the 20th of August, because I'm taking a couple days off. This is part two of what was going to be way too long of a video last Friday. And I wanted to talk about three topics. Several topics. The first one is the suspension of the official sector dollar gold convertibility on August 13th, 1971, 50 years ago this month. The second one is companies holding cash reserves in gold and silver. Both of these things have been currently discussed in the market, one for anniversary reasons and the other one for other reasons. And then I wanted to go over some of the questions and comments that we've received. You know, there are too many for us to respond to all of them. Some of them we respond to on the YouTube section. Some of them we sort of say, hey, this is better to talk to people through the videos as opposed to typing out responses. And when I get to that, you may have to excuse me because there's very small type with the questions and comments that my colleagues think I should be addressing. So let's get into it. The suspension of the dollar gold convertibility by central banks, other governments and central banks, occurred 50 years ago this month. I made the comment on our April 17th video that it really wasn't a surprise. And those people who keep calling it a Nixon surprise, they weren't there. I said I saw it coming, and a lot of other people saw it coming. And one person wrote a rather lengthy treatise saying it was a surprise. I was a coin collector at the time. It was a surprise, believe me. And you know, I had mentioned I was in high school and I saw it coming. And he said no friggin' high school student knew about it. Well, let me tell you a little bit about why it wasn't a surprise to me and to a lot of other people. First off, there were decades from 1945, late 40s even already, through the 50s and 60s of devaluations and currency market instability under the Bretton Woods dollar gold convertibility system. And for those people who don't know, under the Bretton Woods gold convertibility system, the Treasury Department actually had windows on the ground floor of the Treasury. One window was the public window where governments and central banks could say, I have a bunch of dollars and you have a bunch of gold. I'm going to give you your dollars back and you're going to give me gold at $35 an ounce. And it was fixed at $35 an ounce. The other one was the private sector gold window where individuals and corporations and commercial banks and other people who had dollars could also exchange their currencies for gold. And earlier, we got rid of it in the 1960s. Oh, I'm sorry, I wasn't involved in it. By that time, I was in grade school. We as a country closed the silver window in the 1960s, where you could take silver certificates and you could take them to a nationally chartered bank. And I have some silver certificates here in my desk, but I won't bore you with them. I'll bore you with other stuff. You could take a silver certificate or to a bank and say, give me the silver at $1 an ounce. $1 an ounce, yeah. So there were a lot of devaluations and all sorts of currency market instability leading up to 1971. There were economic disruptions and damage caused to governments and corporations and others because of the fixed exchange rates. The run on gold by private investors was so great in 1967 and 1968 that in April of 1968, after the Tet Offensive, LBJ closed the private sector gold window and said private individuals can no longer bring their dollars to the Treasury or Treasury banks and convert them to gold at $35 an ounce. So private individuals around the world, especially in Europe and Japan, which had a surfeit of dollars, would give those dollars to their central banking system in exchange for their local currencies or something else. And then those central banks would take the gold to the US government, which is why from 1968 to 1971, you continued to see a drain on US gold reserves because the public sector window was still open. So Nixon closed the public sector window a little over 3.5 years after LBJ closed the private sector. We had London move away from a fixed exchange rate and create the London pool to start trading gold on a floating price basis in 1968. There were many public discussions and papers being written by economists and policymakers at the IMF, the US Treasury, other central banks, the World Bank, universities. There was a lot of discussion about how the dollar gold convertibility under Bretton Woods really was causing a lot of economic damage and probably should be replaced by floating exchange rates. It was so obvious that the Chicago Mercantile Exchange created the international money market, drafted contracts to trade currencies once Bretton Woods ended, submitted those proposals to regulatory approval, and had put together a delegation of exchange officials and traders to go through Europe, meeting with central banks, ministers of finance, and others about the inevitability that the dollar gold convertibility was about to be suspended and that currencies would be floated. So it was pretty obvious to people, at least in the banking system and reading the newspapers, that this was coming. It wasn't really a surprise. And there were other developments too. Now, footnote about my parents and me. My parents were big gold and silver investors. My father actually used gold and silver in his business, and he had a treasury license that allowed him to buy and own gold because it was central to his business. And he would buy excess inventories, let us say. There were other things that other individuals, including my parents, did at the time. And when my mother passed away, we had a number of watches that were $5 pocket watches put in a crudely made 23, 22, 24 karat gold case. I think they were 22 karat gold cases. And jewelers around the country would sell these watches for $50. Each case was exactly 1 troy ounce. So you had $35 worth of gold, and a $5 watch, and $10 markup. And people could buy those watches, and everyone on the street knew, hey, that's 1 ounce of gold. So you could get around the prohibition in the United States of not being allowed to own gold by buying these watches and having that gold. And people did that. So there was a lot of noise out there that the gold dollar standard and convertibility was going to end. So the idea that some friggin' high school kid could see it coming wasn't a surprise. Now, I mentioned one book, The Nation of Counterfeiters, last week. It is the best book I've ever read on the US currency system prior to the creation of the Fed, specifically in the 19th century. The counterfeiters were the state chartered banks who issued their own bills and ostensibly had the state say, now, if you're issuing currency, your bills, you have to have a certain amount of gold or silver in your bank vault to cover those notes. But the states didn't audit them, and the banks realized no one was looking over their shoulders. And lo and behold, back then, bankers were maybe less than fully ethical. Not all bankers, but some bankers. And you would have serially situations where people say, hey, I've got these banknotes from you, give me the gold. And the gold wasn't there. And then the guy would say, I went to the bank and I tried to get my gold and it's not there. And all of a sudden you'd have a run on that bank. And it happened over and over again throughout the 19th century into the 20th century. And the panic of 1907 was a bank run, started with a bank run. And this guy, JP Morgan, actually bailed out the country, as I mentioned, I think a couple of weeks ago. So the Panic of 1907 is a very good book, but it only covers the Panic of 1907 and what it did. And gold is central to all of this because there was gold sloshing back and forth between Europe and England on the one hand and the United States trying to support the economies. But this bank run, because of fraudulent banking, actually almost brought down the world economy. It was bad. And we had a series of problems after that, from 1907 through 1913. As I said a couple of weeks ago, 60 of the 90 months in that period of time, the United States was in a recession. So there was a lot of pressure that we really needed nationally chartered banks and a national bank to ride roughshod and to actually undertake audits to make sure that the banks, the commercial banks, actually had the reserves in their bank vault to cover what they were lending out. It's very interesting because Thomas Jefferson actually had a famous quote about the thing that would bring down democracy is commercial banks that have that unfettered commercial banks. And some of the permabulls and the people who don't like the Fed take out the word commercial. And they say, well, Thomas Jefferson said, an unfettered bank is the worst thing that could happen to democracy. No, it's the commercial banks. He was arguing that there should be a nationally chartered bank. But the banks fought off politicians and said, no, we really don't want nationally chartered banks. Two really good books. If you want to actually sound like an expert on monetary policy and know what you're talking about, read those two books, as opposed to some of the other spooky stuff or listening to some guy who really doesn't know what he's talking about. This is the ultimate book. Milton Friedman and Anna Schwartz, Monetary History of the United States. It's dated, but it is a great book. And you can see a little bookmark in there. That is a bookmark that is tagged to the turning in of gold in 1933 under FDR. And there's a big footnote. I mean, half the book is footnotes. Milton Friedman and Anna Schwartz were fabulous economists. Anna was at Columbia University. Milton was in Chicago. I had the pleasure of being seconded. My research department at JR and I were seconded to work with Anna Schwartz. She was the chief economist on President Reagan's Gold Commission. And we were the research group that provided her the background data that she needed on gold and stuff. And it was great to be able to work with her. But this book, kind of thick, very academic, very accurate. And that bookmark talks about how there was like 11, 12, or 13 million ounces of gold that was not turned in under the 1933 decree saying turn in your gold. And so the Treasury said, well, this must be gold that was either exported or lost. And as anybody who's involved in gold knows, you don't lose an ounce of gold. Yeah, you might lose an ounce of silver and not search for it, but if you lose an ounce of gold, you can find it. So that wasn't lost. It was just not turned in. Two other books, both by Barry Eichengreen, economist out in California. I think he's still practicing. I mentioned Exorbitant Privilege. That is a wonderful book that again, everybody should read. Golden Fetters talks about gold and the use of gold in monetary systems leading up to the Depression and contributing to issues in dealing with the Depression. But Exorbitant Privilege is a great book because it discusses that whole period after World War II and the series of financial calamities that were either caused by or exacerbated by the rigid currency system that we had under Bretton Woods with the dollar gold convertibility fixed at $35. Then he has two chapters. One is, hey, what if we get it right going forward? And what will an international currency regime look like if we do it right? And then what if we do it wrong? So it's a great book to educate people about, you'll find a lot of people who are nostalgic about the economic stability that didn't really exist under gold standards. This is the book that will tell you how scary it was if you didn't live through it. And even though I was a grade school kid and a high school kid, I lived through it, and my father lived through it, and I watched them. So these are two more really good books to read. Now, companies holding cash. Planeteer is a company that is valued at $20 billion, is owned and run and operated by people that I would not deal with. I just don't, I have a level of ethics that belies other things that people say about me without knowing me. It's never reported a profit in its 17 years of existence. And it took $50 million of its cash reserves in the second quarter and bought gold. And, the gold promoters have made a big deal. Whoa, this is remarkable. A company putting gold reserve, some of its cash reserves into gold. And they did that, they said, because, the risks of black swan events was such that they wanted to diversify their holdings away from just US dollars and other currencies into gold. Now, at $1,800 an ounce, $50 million is only 28,000 ounces. So it's less than a ton of gold. It's not the kind of thing that moves the gold market. And Planeteer is not the kind of company, that's like saying, we always joke in central banks. Central bankers around the world watch what the US does, watch what the Chinese People's Bank of China does, and they say, yeah, that looks smart. They don't necessarily look at Russia and say, hey, here's a pariah state that's corrupt and et cetera, et cetera, et cetera. What are they doing? Maybe we should emulate them. In the corporate world, I don't know anybody who would say, gee, Planeteer's doing that. That sounds like something I want to try. But it was interesting that they did it. It's not new. Corporations have been holding cash reserves in gold for centuries. Even recently, they've been doing that. And to compare the size, the French President Macron, another thing that's been in the news, had a proposal that the IMF should sell 100 million ounces of gold, $100 million worth of gold. It has about 90 million ounces of gold that it has. It sold some in 2009, 2010, I believe, to raise money because the Bush administration had refused to pay the US dues to the IMF for several years and was cash starving the IMF because Dick Cheney thought that the IMF should be closed down because it was a multilateral institution, and multilateral institutions blocked the US from doing things that it wanted to do unilaterally that the broader world said, no, let's not do that. So he proposed that the IMF might sell $100 million worth of gold, which is about 56,000 ounces of their 90 million ounces. And frankly, I don't know that that will go forward. If it does go forward, it's probably going to take a decade or so to negotiate. The reality is that 56,000 ounces is not a lot. It's not going to have any noticeable impact on the market, and it probably will be restituted or sold to member governments, member central banks, rather than sold into the market, because that's what they did for the most part in 2009, 2010, is they restituted some and then they sold. They offered it first to other central banks and that were members of the IMF, and central banks, I think, bought all, if not all, most of it there. And unfortunately, $100 million is not going to solve the massive indebtedness of African nations. But that's out there, it's there. I wanted to talk a little bit about the idea of holding company cash reserves in gold and silver. Like I said, it's nothing new. It's been done for centuries. It's been done in recent modern times. CPM Group in 2001 helped IM Gold set up a program to hold some of its cash reserves in gold. IM Gold started production of gold at its first mines in 2000, 2001, and they were, producing gold in Africa, selling it for US dollars, converting the US dollars to Canadian dollars because they were a Canadian company, and they were suffering various transaction costs for all those currency exchange for the currency exchange, but more importantly, they were vulnerable to changes in the dollar, the exchange rate between the Canadian dollar and the US dollar. So they actually started asking us about how they could hedge their Canadian dollar exposure. And we were showing them an option-based strategy, which was kind of convoluted. And finally, I said, well, why don't you just stop selling your gold? I mean, sell the gold that you need to sell in US dollars for operating expenses, and the gold that you don't need to cover operating expenses, just put it in your reserves. And, it's not a taxable event if you mine gold and don't sell it. So there are advantages to it. Plus, you can go to your shareholders and say, you're buying IAMGOLD shares because you want exposure to gold prices. And not only are we giving you exposure to gold prices by the fact that we're a gold mining company that is now actually producing gold, but we're holding some of our reserves in gold. So they did, and it worked very well. I don't think they do it anymore. I think management's changed over several times since 2001, and I don't know what they're doing. McEwen at Goldcorp saw what we did because IAMGOLD came out with a press release and did it there. But he's a better promoter. So he said that it was his idea and it was his first, he was the first out of the block, even though IAMGOLD preceded him by 6 months, 8 months, 9 months. And then we did it with Silver Standard, with silver in 2004. The Silver Standard had cash. They were going to need the cash at some point in the future to build a silver mine, but they didn't need it right away. So we worked with them to put some of their cash reserves into silver, giving their shareholders a double fillip in terms of exposure to silver. And also giving them exposure to silver at a price around $4.80 just before the price started rising. Others have done this after that. I don't think a lot of them have. I don't know why they have. We're always suggesting it to mining companies, but they haven't done it so far. It's an interesting thing. So questions, comments, answers, reactions. I'm not going to deal with the prepubescent ones, of which there are a dwindling but still significant number. This fellow said, can anyone guide us to the short-term trading signals that various people were mentioning in the comments to our thing? Yes, our gold and silver trade recommendations are available to retail investors as part of our retail investment program. We also do work on trade recommendations for platinum, palladium, copper, and petroleum, and those get handled as client-tailored consulting packages. And quite frankly, the gold and silver often fall into those categories too. So we'll talk to an investor, retail or larger, and we'll say, well, what do you really need in terms of research, consulting, advice from CPM Group, and we'll put together a consulting package that can include, if they want, not only our trade signals, our trade recommendations. Right today we issued a trade recommendation on gold. The gold ones actually also go out by Kitco at trade signals, and they go off in some markets with GoldX app, a company that allows you to buy and sell gold on your phone. We issued a gold trade recommendation this morning that said, price is 1780, 1784, whatever. And it reiterated our sell signal from last week saying, we're looking for the price to fall to 1770 initially and possibly further. So if you're a short-term investor, we would be short at this point. So we do that. There's a link at the end of this presentation to our website, and you can go to our website and find that. If you want to talk about some sort of specialized consulting package, you can send a note to info@cpmgroup.com, and we'll talk to you about that. Michael had a comment, which I wanted to talk about. And, my colleague said, why are we talking about this? He said, well, I tend to be, I'm not a contrarian. I look at the fundamentals, I look at the macroeconomics, I come up with my own view. That view oftentimes is quite mainstream with key financial markets. It will be contrary to the perma-bulls who, $10,000 gold by Christmas, don't worry. It will be contrary to the people who really, really, really want to believe that gold can only rise and silver can only rise. And I know that feeling that you have a conviction, you have a view, and all of a sudden everybody else starts agreeing with you. And you say, gee, am I wrong? Because they're clearly wrong, at least in their rationale. And I wanted to put this up because, it's very important. It's a very cardinal mistake that investors make. They change their convictions because they realize that people who don't know what they're talking about have the same outcome projection. And you can sit there and say, I have a lot of really good reasons. We do, and a lot of our clients do. We have a lot of really good reasons: economic reasons, financial reasons, political reasons, fundamental reasons related to gold and silver supply and demand to be bullish on gold and silver over the next 5-10 years. But you listen to all this garbage and you say, wow, maybe I'm wrong, because these guys are also bullish and they're clearly don't know what they're talking about. And it's a cardinal mistake to change your view simply because other people who clearly don't know what they're talking about have the same price outcome that your more realistic analysis gives you. So I just wanted to say that because, Michael, you need to focus on what you know, not what other people say. And it's probably a broader thing worth going on. Now, this guy wrote, I made a joke that I had said that I thought that right now gold and silver prices were rising in part because of concerns over the economic consequences of the Delta variant of COVID. And I said that we expect to dissipate in the next few weeks. And then I clarified myself. I said, the investor concerns about the economic consequences of COVID, we expect to dissipate. COVID will not go away because, as I said, the boys in the South will assure that. And Richard Fetter from Fort Lee, New Jersey said, oh, you're so arrogant, you're so condescending, you're so elitist, talking about the South. Well, dear Richard Fetter of Fort Lee, New Jersey, it's not elitism, it's not arrogance, it's not condescension. It's simple math, it's simple reality. Face the facts. The southern tier of states have the lowest inoculation rates, the highest rates of infection, the highest rates of hospitalization, and the highest rates of death. It's not condescending to state the facts. It's condescending to say, let's not hurt those boys' sensitive little psyches by saying, wow, look what they're doing to the world. It's sort of like saying, hey, that teacher was condescending. That elitist teacher was saying to me that I really need to learn how to read and count and think critically. It's not condescending. It's good advice. So that was one. Let's see what else we have. I also said something about the fact that the historical analogy to the fall of Afghanistan was not Vietnam, but Cambodia. And somebody said, oh yeah, everybody remembers picture. Yeah, if you're thinking about the fall of Afghanistan as being the last 10 days, you don't know what it means for Afghanistan to fall. I mean, this war in Afghanistan was lost in December of 2001. We invaded Afghanistan on October 7th. Within 2 weeks, the Taliban offered to surrender. And the US government declined the opportunity to accept that surrender because we wanted to build a nation there as opposed to get rid of Al-Qaeda and the base for Al-Qaeda. And then we wasted 20 years and thousands of American lives and hundreds of thousands of Afghan lives, and all for a foregone conclusion. So if you think in pictures, like those little memes that Mike Maloney likes about me, then you would think that, oh yeah, those guys evacuating the Saigon embassy by helicopter on the roof is a lot like what's going on at the Kabul airport right now. And you'd be right. But the real failure in Afghanistan actually was in December of 2001, and then for the next 20 years, right? And you have to, what I said was, the Taliban is the Islam, what the Khmer Rouge was the communism. And the Khmer Rouge took over, and they killed more than 2 million people. And they didn't just kill them, they killed them brutally. Like sometimes they executed them en masse by beating them over the head with boards and bats. And then they collected the skulls and made a museum because they were so proud of the fact that they had killed 2 million people. That was the failure of Cambodia. And we have to see what happens in Afghanistan. Now, the two natural predators, natural antagonists to Afghanistan and the Taliban are Pakistan and Iran. And the Pakistani government has traditionally sort of tried to play along with the Taliban, but that may be changing. And the Iranians don't like the Taliban because they give fundamental Islam a bad name. So if the US were smart, we would stop harassing Iran and let Iran focus on its enemies across the border, because it's Iran's problem now. Now, a few other questions. I'm going to put my glasses on because they're in such small type. Somebody asked, which price? I'm not quite sure what the question reference was. Which price? Is there a spot price and a premium price? And then somebody else said, okay, yeah, so let's deal with this one first. I was talking about the fact that people pay too much for their precious metals. And there are people who sell precious metals at too high of a price. And you can talk about the price you pay, or you can talk about the premium over a spot price. And then you have to say, by the way, hey, by the way, what spot price are you using? Are you using spot London, spot New York? Are you using COMEX spot? Or are you using a dealer spot price? So it's very tough. And we've worked with some of the largest companies in the world. And what we have pointed out, because sometimes they were buying basis to premium, but they didn't specify what the basis was. And what we pointed out is you really have to look in the full in price. I was just looking this morning. Well, this goes to the next question, which is, so CPM Group, so it is the greedy retail dealers then, I guess, that are causing problems. How dare they make a little extra profit margin when the supply is outweighed by demand? What is this, capitalism? Well, it's unrestrained capitalism. And it's unrestrained by intelligent consumers. And I looked at Silver Eagles today, and one of the companies that we like to work with that often gives our clients really good deals had Silver Eagles at, I can't remember the price, $30 and some odd cents. And then one of the other guys was at $31 and 80 some odd cents. So he was 7% higher than the other person. So yeah, it's a free market. Anybody can sell this stuff at any price they want, and anyone can buy this stuff at any price that they want. That's a free market. No one's saying, hey, your premium has to be X, Y, or Z. But intelligent consumers will shop around. And when they find someone who's consistently lower priced, they may just buy from that person. We had a gold mining company in the 1990s ask us, how do we know if we're getting a good gold price? It was that whole thing. It was like, oh, what's the premium over the market? Well, which market? COMEX, spot New York, because COMEX is not necessarily spot, or London AM, PM. And we said, you have to, we knew the company, we had worked with it for more than a decade. We knew that it sold its gold to one bank, that it called that one bank most every morning and said, what's your price? And they would say, okay, we'll sell 5,000, 10,000, 15,000 ounces. It's a very large mining company. And we knew they never asked a second bank. This is mid-1990s. We said, the way you know that you're getting a better price, or the best price, it may not be the best price, but a better price, is to ask more than one bank. And most of your competitors ask 2 or 3 or 4 banks every day. Hey, what's your price? Send me your price every morning, and I'll ask, and I'll decide, who I want to sell to. That company stopped using us, after another decade. It had lost hundreds of millions of dollars on a hedge that its bank sold it. We had given it a hedge that would not have lost it hundreds of millions of dollars. And they said, why are you listening to CPM Group? We have a really good one. It's 3 years of puts paid for with a bullet call at the end. And it cost them hundreds of millions of dollars ultimately, and froze up their credit line. And so they stopped using us as advisors, because no one likes a smart aleck who knows how much money you lost because you didn't listen to his advice. But we do know that in the ensuing decade, they never called a second bank. So you have to watch out for what your price is. And yeah, there are people who sell basis of fear mongering, and they like to get people riled up. So you got to buy. I mean, I mentioned on my April 17th or August 17th thing, people buying gold at $2,000 last August, and silver at $31 an ounce. Prices that we haven't seen since the spot. So there are all kinds of differences in prices. And one of the reasons why we don't have an official forward price is because on the forward basis, it's a credit issue. So if a central bank comes to you, you have pretty good credit. If another commercial bank comes to you, you have slightly less credit. Depending on the bank, you might have a lot less worthy credit. If it's a jeweler, it's a different story altogether, because most jewelry companies are privately owned and they're not as credit worthy as if it's a mining company, it's somewhere between a jeweler and a commercial bank. So when you say what's the forward price in London, there is no forward price in London per se. Each bank will have a forward price for each customer based on the creditworthiness of that customer. And the banks don't necessarily share what their forward prices and their credit ratings and policies are with various customers with their competitors. So there are all kinds of prices out there. And the way you find out if you've got a good price is you work with people that you feel comfortable, that they're reasonably ethical, and you shop it around. And when I say comfortable, that they're reasonably ethical, it's very funny because, when Biden met with Putin a couple months ago in the press conference afterward, somebody said to Biden, one of the press reports, so do you trust Putin? And Biden laughed. He said, no, this has nothing to do with trust. This has to do with, negotiating and paying attention to who you're negotiating with and how honest they are and how dishonest they are and what their actions are. It's not a matter of trust. And the way you build trust with your trading counterparts is you have more than one. And you let them know that you have more. So that's there. Okay, I mentioned in my Friday portion of this, there are a couple of people. So who dumped $4 billion worth of gold in the thinnest market? If that wasn't manipulation, for sure it wasn't to get the best price. I've explained this numerous times. If you look at the trades that occurred, and first off, they occurred in the very active Asian market. If you look at the trades that occurred, there were hundreds of participants all reacting to the same price move, selling that. No one sold 4 billion ounces of gold, $4 billion worth of gold, but a lot of people did. It goes into the nature of the markets. And in 1980, we had more than 90% of the commodities futures trades based on technical analysis. Today, the number is probably closer to 98 or 99%. There are very few companies. We did some work for a client a few years ago, and we did a survey of institutional investors, portfolio managers, and analysts and institutional investors who trade commodities. And what we found was that out of more than 10,000 portfolio managers and analysts, only a handful, like 140, traded metals. And of those, only like 13 traded based on fundamentals. The rest traded algorithmically or based on technical analysis not fed into a computer. That's the nature, not only of commodity markets, not gold, not silver, not commodities. That's the nature of all markets. And one of the big problems with algorithmic trading is, yeah, there's a lot of algorithmic trading that you probably would like not to have, but how do you distinguish one from the other? And you have to understand that because algorithmic trading, for example, with the stock exchange, represents such a large portion of the profits of the exchange, that if the government, in this case the SEC, came along and said, hey, algorithmic trading is no longer allowed, the exchange would go bankrupt, because that's where we are in the world. So you might come along and say some algorithmic trading is bad and we want to stop it, and this is what we're going to do about it. But you have to take into consideration the systemic consequences of changing the rules when the rules have been going on for 40 years this way. So that's another one. Let's see, do I have another question? Scam markets are manipulated 100%. Why else would gold drop from 1800 to 1677 and then back up to 1796 in a few days? I think I mentioned this Friday, for the same reason that the stock market, the S&P, fell sharply on Wednesday at the close and then gained 2/3 of it back on Thursday morning. This is the nature of trading financial assets these days. I've said it's a casino, and it sort of is a casino. And it's sort of the way it is. You shouldn't be surprised that is the way it is. That comes to pretty much the end of this presentation. I did want to talk about one more thing, which I just alluded to. There are people out there trolling me, and they're so pathetic. And we'll skip the prepubescent ones. Let's focus on the ones. These guys are like spending all their time looking at speeches I gave 10 years ago, and a debate I had 10 years ago, and papers I wrote. And it's very funny because they found me criticizing the government, deficit spending, futures trading, calling it a casino, among other things, bank practices, banking regulations, and a host of other issues. They think what they're doing is exposing duplicity in my statements. What they're really doing is they're proving the point that I've been a critic of the banking system and various other things my entire professional career. And it kind of lays lie to the nonsense that they repeat, that somehow or other I am a shill of the banking industry. You know, I've been criticizing banks and banking industry since the 1980s. We worked in 2000 when the Commodity Futures Trading Modernization Act was being underway. We worked first with the silver users, and the silver users and CPM Group put together a coalition of other industrial consumers and users of commodities to go to the CFTC and say, the way you are planning to change commodities trading regulations makes this even more of a casino for the banks and the hedge funds, and less of a place where we can effectively hedge. And the CFTC listened to the industry criticisms and changed the Commodities Trade Modernization Act as a consequence to make it a little bit less offensive than it was. I've criticized the original Commodities Futures Trading Act from 1974-75. I was still in university. yeah, some friggin' university kid knew what was wrong with it and saying, hey, this is really a bad piece of legislation. This is no way to regulate the commodities market. We've worked with various Congress people, with congressional aides and others on trying to bring effective regulations to the OTC derivatives market. This is something that's been blocked by the banking industry over and over again. And I believe you can go to our website in our free reads area, whatever it's called, our market views, and find a thing called 2 letters Ray derivatives. And it's from probably around 2001, when there was a proposal to regulate OTC derivatives. And that proposal basically would have had extremely negative economic consequences for industrial producers, processors, merchants, and users of commodities. So we worked with various legislative aides and legislators on saying, no, this is bad. This is a bad regulation. Here's a good regulation. And we actually worked with a group that got a letter that was signed by the 4 financial regulators at the time, that they sent us the letter and said, hey, tell us what you think about this letter. And I said, this is an incredible letter. It's just terrible. It's not good. It's not realistic or accurate on a theoretic basis or on an empirical basis. And I actually, one of the regulators was Alan Greenspan. I knew, I think all 3 or 4, I think I knew all 4 regulators at the time. And I called up Alan's secretary, whom I knew, and I said, I want to fax you, because it's 2001 or so, I want to send you this letter that Alan signed, and I want you to ask him if he in fact signed this letter. And she called back and said, Alan said that is in fact the letter he signed. No one forged his name on it. He wants to know why. He said that. Why, you asked? And I said, because I can't believe that he would sign a letter that was saying basically, don't regulate OTC derivatives markets for these reasons, because these are not legitimate arguments, either empirically or theoretically. And I can't believe that Alan would sign this. And several months later, I was at a reception, and one of the other 3 regulators was there, and he took me aside and he said, so I hear that you asked Alan, did he really sign that letter? I said, yeah. He said, why? I said, because I couldn't believe that he would sign such a letter. And he said, but you didn't ask me. I said, no, I didn't. I won't go into more details on that letter, but like I said, the letter that was signed by those 4 guys and my response to my client is on our website, I believe, as called two letters Ray derivatives or something like that. Bottom line was the client took my letter and sent it to all of the Congress people who were working on that legislation, as well as the regulators, as well as the Wall Street Journal, the Washington Post, and the New York Times. And that legislation died. And as far as I can tell, we still don't have effective regulations on OTC derivatives. But so these guys are coming up with all this stuff. What they're basically doing is providing you the evidence to see that when they tell you I'm a shill of a banking cartel, all of the evidence they're finding says, even though he's not. On that happy note, pay attention to what's important. When somebody tells you something, say, why is he telling me? Does he know what he's talking about? And check it out. And if you have to, send it by email or fax to somebody and say, hey, is this real? Because a lot of times, a lot of people say things that are not true. Have a good day. I'll talk to you on Friday.